Good morning, everybody. Thank you very much to be here at this early hour. I was hoping to have an empty room, I hope I won't bore you back to sleep. So let's give a go. So this is a joint work as part of our inclusive finance project. This is the second half of the paper we're working on, talking about how the network structure of Kenya interbank market affects the banking sector stability. The first half was presented in Loughborough in January. We still have the same authors. Surprise, surprise, no one dropped out yet. It's a joint work with Pia Weiss from Nottingham University Business School, and we have, of course, Victor and Chris Green in our team. In the first half, we have explained the basic network characteristics of the network overview, the development, the evolution over time of the network with the usual network measures. At the end of the first half, we have done something new, which is to decompose the whole network into components according to the level, well, let's say, their implication to spreading contagion risk in the system. Since then, we have done more detailed study on those components, which will be the focus of the presentation today. In the interest of time, I'm going to skip the usual thing like literature review or detailed discussion about data. I'm going to dive into the results quite quickly. So if you're interested in other parts I skip, please let me know. We're going to talk about three network characteristics: component net weight. We're going to talk about something called gatekeeper net weight, and then we'll say the important or interesting thing is about the contagion measure we have. Talk about contagion risk, and then finally we will show some regression results for the first time, looking at the relationship between network measures against banking sector stability. Then we conclude. So let me have a very brief recap on the data we use, because not everybody was in the January meeting. We use two sections of data. One is the daily bilateral transaction data of Kenya overnight interbank market. We are talking about over 22 trillion Kenya shilling transaction value. So it's a lot of information and data that we have the luxury to. The sample period covers from 2003 to 2012. And in the at the first stage, we have used the structural break test to divide the sample into three sample periods. Although here it's called pre-crisis, during crisis, post-crisis. And yesterday I had a very useful discussion with the governor. So crisis here, really, we cannot think it as a global financial crisis because we know that Kenya wasn't really, their banking sector wasn't really affected by the global financial crisis. But accidentally, in 2007, 2008, Kenya had this post-election violence overlapping with that time. So this is the local crisis in Kenya that we are talking about. This is the uncertainty generated locally. So just in case we mix up the name of crisis. The other section of data we use is the quarterly bank balance sheets data, where we use for the bank risk measure. Okay. The other important recap is about the components themselves. I think it's useful to have a recap about how we define the components, because this is quite crucial for us to understand the results to follow. So first of all, if we look at this big orange bubble, this is called the GWCC. This is the what they call the largest disconnected component in the whole network. So there are several of them in the whole network, but we only focus on the largest one. And then within this disconnected component are the things we are interested. First one called GSCC. In this component, every bank is directly linked to each other So they lend or borrow from each other. All of them are linked to everyone. This is the component last time we defined as the high contagion risk component, GSCC. Then we defined as some sort of core in the network. Then we have another two components here. G out is a periphery as well as G in. So G out, the banks in G out, they only borrow from banks in GSCC, meaning the peripheries, they only borrow from the core. They don't lend to banks in GSCC. And it's the other way around for G in, they only lend to banks in the core. So the rest of them in the component is like K and J. Those banks are isolates. We call them tendril, meaning they are not on any direct path linking to the core. They only link to the periphery. So those are the components that we are talking about. And the core is the high contagion risk component. G out, the lender to GSCC are the limited contagion risk component, and the rest of them, we say they are no contagion risk. But this is a very crude observation at the beginning, but there are more details to come, so I'll show you. Now, at the end of the last presentation, we show those charts. I want to draw your attention to the stacked column, the black one, which didn't appear before the crisis and after, only in the middle. So what are they? They are the size of the GSCC, the core, the high contagion risk component. And then when you see the tendril, which are the safest components, they don't affect anyone. And this is the gap we see during crisis time. It's a disappearance of the safe component, but the appearance of the high contagion component. That's the most alarming message we have at the end of the last presentation on components. So we are going to look at how they link to each other in more detail in order to know how risk may or may not pass between the components, meaning spread to the system. That's why we are interested. Okay. So first network characteristic on component we are going to talk about is called net weight. It's calculated as a difference between lending and borrowing within the component. So this is the key, within the component. So at the moment, we are not talking about other components yet. Therefore, if you see a positive value, we are talking about a negative lender, a net lender. And if it's a negative value, we're talking about net borrower. So let's see who they are. There's a lot of information there, but let me just point out the key ones with the time we have. During the crisis time, we always found in any component, large banks are the net borrower, and the fund is supplied by the medium banks and sometimes small banks, but medium banks are constantly the net lender to large banks. After the crisis, the pattern pretty much stayed. And then if we divide the banks according to where the headquarters are, local versus foreign bank, now we see local banks is the net lender supplying funds to the foreign banks, especially during crisis time. So we have plots like this. This is the during crisis time net weight by location. So you can see over the time we do have change of as a net lender or net borrower by the local bank. Over time they do change, but when we see average, on average, then we found foreign banks are the net borrower. And then if we divide the banks according to the ownership, whether they are listed or whether they are private, what we see is listed banks now are the net borrower, borrowing funds from the private banks. So we put them together, we found mainly if we only consider the net weight within the components, it's the foreign bank, the listed bank, and the large banks who are the potential banks can, if they fail, if any of them fail, they can pass the risk to the rest of the system, especially to the other type of banks, potentially can trigger the contagion risk, which we're going to look next. If you look at the amount of net borrowing, large bank is the one have the largest exposure, and foreign banks has the smallest one. In our sample, there are 3 banks, without naming, there are 3 banks who are the foreign listed large bank at the same time. So it's not a lot of them, but they do have a very large exposure. Okay, so the next network characteristic that we are going to focus on is called the network of the gatekeeper. So what do I mean by gatekeeper? Now, if we look at this graph, Bank A in GSCC lend to bank in Jiaot, for instance, D3 or D1. So in this case, D2 has nothing to do with GSCC directly, right? So banks like A or D1, D3, they are the gatekeepers of their own component. So A is the gatekeeper of GSCC because they are involved in the transaction to other banks in different components. But like D2, it's not directly connected to the other components, so they are not the gatekeeper. So here, what we are interested in is the net weight of those gatekeepers, meaning we're only interested in what's the exposure of those banks actually can be the channel of spreading risk to other components. Okay, so in the interest of time, I know I'm running out of time quickly. Let me give you the summary directly. When we look at G-in and G-out, as the definition of the component, we can see G-in is always the net lender, and the G-out is always a net borrower, because that's how we define the component, so it's good, it's fine. But if we look at the other two, Tendril and the GSCC, of course, GSCC is a high contagion core. That's the one we are most interested in. Let me show you the summary. The summary is large banks, during crisis time, they are the net borrower gatekeepers. Therefore, we can see the failure of the large bank, they can not only affect other banks in GSCC, but also they can pass the risk to other components, which is meaning in the system. After the crisis, we have both a large bank as well as private banks become the gatekeeper net borrower. So the dynamic, the structure of the network changed a bit after the crisis. Okay, so let me move on to the third network measure, which is to look at the contagion risk directly. How do I mean that? We are looking at different scenarios. If you remember the bubbles, there are different ways that they are connected to each other, and there are 9 scenarios we found. Each scenario can be characterized into different contagion risk level according to how wide spread the risk can be in a system. The highest level is level 4, where, let me just give you this because this is a key thing we need to know before we get the results. So for instance, D1, D3, these are the borrowers in G-out. They borrow from a bank in GSCC, say A, and if D1 or D3 failed, they can't meet the obligation of payment, their failure could potentially affect the bank in GSCC A. So because everybody in GSCC is connected, then the failure of A, if things get worse and worse, could affect everybody else in GSCC. Now, the banks in G-in lend to banks in GSCC. So the failure of anyone in GSCC could potentially, for example, C, affect banks in G-in. Therefore, you can see, just because the failure of a borrower in G-out could, if the things get worse and worse, could potentially spread out to the other components, meaning the system. So this is the worst scenario, the level 4, but it can, with the different type of links, it doesn't have to be this bad. Okay, so the key message is if the borrower is in G-out and the lender is in GSCC, that's where we start our rolling of the domino effect. And let me show you the involvement of different banks at different level. So during crisis time, if you focus on these are different columns showing different level of contagion risk. What we see is, this is pre-crisis. During crisis time, large bank, 21%, this is medium. Large bank, 50 to 52% of the large banks are involved or contribute to level 3 contagion risk. This is the largest one relative to any other bank size. And not surprising, because during crisis time, large banks are the largest net borrower in G-out, and they are the gatekeeper net lender in G-in, as well as the largest net lending bank in GSCC, exactly the scenario that we have discussed early on. So if you divide them by local and listed bank, it's the local bank imposed contribute most to the contagion risk. And if you look at foreign versus listed, this time it's a listed bank contribute most to the high level of contagion risk. And the reasons are pretty much similar. It's all about their net position, whether it's gatekeeper or within component net position that we have discussed. This is the main reason. Okay, let me get to the last section before I run out of time. The last section is where we use a two-stage approach. At the first stage, we run a regression of the z-score measure, which is a distance to default measure we have, on two sets of vectors controlling for macroeconomic condition as well as bank-specific characteristics. And what we need is the residual from the first stage, because at the second stage, we run the regression of the residual on the group of the network measures that we have generated at the first stage. So they are whole network measure, they are individual node measure, as well as the component measure we just presented. There are more, but I didn't have time to present. So let's see. This is the scary table that it's too much information, and also same here. So let me go into detail on some individual significant variables to give you example of how they are linked. For instance, we don't look at individual bank in the regression. We look at banks according to their bank group, the attributes we talked about, small, large, medium, etc. So in general, we found that network measures, we do have a lot of them being significant in determining bank risk. Especially the component-related measures are the key determinants, which is really good finding for us, because we do find them tend to be the one much more related to idea of contagion relative to other network measure. So for instance, here what we see in this result is the standard deviation of the net cost in a G-out component. If the standard deviation increase, then we see the risk for the small banks increase as well, because here is the z-score. The smaller it is, the less stable the bank is. Why that should be the case? We have some important reason here, because small banks are the net lender in G-out throughout the sample period. When the funding costs become less stable, less predictable, it increases the uncertainty for small banks. Therefore, not surprisingly, we see the small banks become less stable. And if we look at large banks, in this case, it's the net weight of large banks in G-out component. When that increase, we see large banks risk increase, or let's say become less stable. The main reason is we think large banks are the main contributor to high contagion risk level, as we have just saw. They have this is because their net borrowing position in Jiaot. Therefore, when this net weight increase, unavoidably, the risk level of large banks will increase too. So if we... Sorry.
Could you move to conclusions, please?
Yes, I will. The conclusion, I can just finish the medium bank one word. Yeah. For the medium banks, we are looking at a whole network measure, which is number of edges, meaning the number of transactions within the network. So when banks are more closely connected in GSCC, especially for medium banks, their risk level increased as well. And we think the reason is because GSCC are the net lender. When the connections increase, meaning they are more closely related to other banks via lending. Therefore, there's a higher chance for them to be exposed to potential domino effect. So you get the idea of how network measure related to bank risk. So the conclusion is, as we have seen, the large bank, listed bank, and foreign banks are the main, let's say, systematically important banks according to net weight only. If we look at net weight within the component as a gatekeeper, then the picture changed. It's a large bank and the private banks. Therefore, it's not just net weight itself, whether they are net borrower or not. It's more about being net lender or being net borrower, how you connect to other components, how you link with each other, which is what we have discovered in the contagion level measure as well as our regression. So the most important thing to know here, well, the most important one is to know it's not just the net weight as we see in some network paper. It's looking at banks sitting in different core, in different periphery, but how they are connected is the way to look at different level of contagion risk they impose. So let's meet. Thank you very much. Sorry for the delay.
Got about 8 minutes for questions. Any questions? Yes. Yes. The microphone.
Yeah, can I just understand why you chose to look at net risk? Because it seems to me that the key factor is actually gross risk. Because if you look at, particularly look at credit risk, but also liquidity risk, you can't really necessarily net it off. So when you look at the exposure of an institution, it's really on its gross exposure, it's not its net. Seems to me. So I just wonder if you could comment on that. I also just. In terms of your analysis about the large foreign unlisted banks, obviously in Kenya they're kind of one and the same thing. So we're actually looking at a single group of banks rather than separate categories. But also, is there some element in your model that weighs in about their ability to absorb losses? I'm thinking of large banks, although they might have greater connectivity, they also have greater ability to absorb capital losses, particularly if they're ones that are under systemically important institutions and therefore have greater capital ratios than they would do for smaller institutions. I just wondered how you've dealt with that in your model.
And I have a related sort of question.
Please.
Have you tried to utilize some market-based measures of risk, like S-risk, for example, which would capture exactly the direction of the bank to the shocks, external shocks?
You could back test this model against actual systemic crises and see.
Yeah.
Because I'd also say it's like the idea that a crisis starts as a large institution.
But very often the crisis is modeled as external shock rather than decline in the stock market, for example, index, the global stock market index, which...
Yes, I wonder whether it would correlate with the
absolutely,
I don't know
so
if that's beyond the scope of the paper.
Yes.
So can I...
Shall we collect questions and then...
Okay, sure.
So it's related really to Judith and your comments. My first point was that it's interesting because, I mean, the mainstream literature has always argued that foreign banks are actually counter-cyclical, that they can bring money in during a crisis. So what you're showing is particularly interesting because it's exactly the opposite, which I think has happened also in other regions in Eastern Europe, in Argentina and so on. But I was also wondering if, as a next stage, one could think about the policy implications in terms of maybe the big banks also, because they're systemic, as Judy said, have more access to lender of last resort facilities, both through the IMF or through the National Central Bank. And therefore, maybe they're willing to take more risks. And then, but that, on the other hand, creates all the problems of moral hazard, too big to fail, but also too big to bail.
Indeed. Thank you very much.
Thank you.
I think there's a question.
Yes, thank you. It's a wonderful paper, and I was listening with keen interest as a central banker. So what is your key message to the central bank? What recommendation would you give? In other ways, how can the network structure be disturbed in order to reduce contagion levels?
Thank you. Maybe last question, and then we'll move on to answers.
Yeah, my question is actually quite quick. What measure exactly do you use to measure contagion risk to determine those levels, the contagion levels?
All right. Thank you.
Thank you. Okay, so I'll go one by one. In terms of the liquidity versus whether it's liquidity or credit risk, because this is overnight interbank market, if one bank doesn't pay to the lender, so first of all, it is a default event, so we're talking about the credit risk. But liquidity risk is part of it because if it is indeed crisis time and there are a lot of failure of repayment, then it gradually, not gradually, but probably very suddenly, the lender would face liquidity shortage. If 80% of the banks fail to pay back their loan, then this credit risk very quickly would roll into a liquidity risk crisis. So we don't model, let's say, or say it explicitly, but maybe this is something we can do next stage to see how things evolve, gradually getting, if it gets worse and worse at a different contagion level, then how that can affect the system. I think that could be something interesting to look at. I don't know if I answer your question that way. And the other one you were talking about, how banks have the ability to counter the loss. I think this is the urgent part of the model that we really need to think about, because we do know banks have the ability to be, well, not ability, they may have a deposit insurance, they may have a last lender reserve from the central bank, etc. So none of those regulator policy being incorporated in our model yet. So no, we haven't put that in. But this is totally valid, and we need to think about how we can incorporate these ideas. And when we talk about market-based measure, this is really interesting. I'm glad you asked, because initially we want to construct a measure much closer to contagion risk that a bank exposed to, rather than just a general bank risk as a Z-score. But we searched again in the literature, and at the end, the conclusion is, if we want to use the real data rather than simulation, we have to rely on balance sheet-based data, because in Kenya, it's a relatively smaller proportion of banks are listed. So if we use market-based data, we have to give up on large chunk of the sample. Therefore, for whether it's an explanatory variable, whether it's a dependent variable, we simply cannot rely on market-based data, simply because they are not that common in Kenya. So the next question talk about, yes, the comments about foreign banks. I totally agree, because we see, I didn't go into detail, but before crisis, foreign banks can be the supplier of funds to the local banks. But then once you go into this uncertain period, the role reverse. And we see this in various network measures, not just here. They constantly come out, this pattern. So what we see is quite persistent in different network measures. And it is really interesting message that foreign banks may not always be the savior to the market, and I totally agree. But what can we do as a regulator? We know who are the systematically important banks. What can we do? I was talking to the governor yesterday about this. Obviously, it's difficult to set a separate rule or regulation to only targeting at foreign bank, let's say. But I think one thing probably the central bank as a tool in their hand is probably the requirement on capital adequacy ratio. Maybe they can make it tiered, or maybe they can tailor-make it towards different type of banks according to how important they are systematically. So this is linked to the next two questions. What's the key message to the central bank, and what can they do? I think by using this method, we identify, hopefully, the systematically important banks, therefore knowing who they are, and we cannot break the network. That's because the transaction has to go on, right? So whenever we have the transactions, the network will be there. But the idea is how we can set separate measures in order to limit the damage when the damage comes. I think that's the key. So the last question about how we measure contagion risk. What we have done is, like I explained, there are different 9 scenarios. You can put different links into category, right? I explained the level 4 example there. So we count the number of, they are dummies, we count the number of appearance, the number of involvement at different level of contagion risk. Then we divide it by the total number of banks on that day involved in the transaction. So it's a proportional involvement, meaning, say, 52% large banks are involved in the level 4 contagion risk. So we're looking at a proportion involvement of the risk. But how we define the risk is all about between different components, how they are linked to each other. I can tell you more about the different scenarios if you are interested during the coffee break. Yeah.
Okay, thank you.